Hello everyone. Today, we'll be presenting about ratios in accounting. This presentation is brought to you by Dini, Arif, Danny, and Usman. Let's get started. What is ratio in accounting? Well, ratios in accounting are tools used to evaluate a company's financial performance. They help stakeholders analyze profitability, liquidity, efficiency, solvency, and investment potential. Profitability ratios. These ratios assess how effectively a business generates profit. 1. Gross profit margin formula. Gross profit divided by revenue times 100 purpose measures the percentage of revenue retained as gross profit. Interpretation. A higher ratio indicates strong cost control. 2. Markup formula. Gross profit divided by cost of sales times 100 purpose shows the percentage added to cost to generate profit. Interpretation. A higher ratio is typically better. 3. Operating expenses to revenue formula. Operating expenses divided by revenue times 100 purpose assesses cost efficiency. Interpretation. A lower ratio indicates better expense management. 4. Profit margin formula. Operating profit divided by revenue times 100 purpose measures overall profitability. Interpretation. A higher ratio indicates greater profitability. 5. Return on capital employed, ROCE, formula. Operating profit divided by capital employed times 100 purpose evaluates how effectively capital is used to generate profit. Interpretation. A higher ratio is preferred. Liquidity ratios. These ratios measure a company's ability to meet short-term liabilities. 1. Current ratio formula. Current assets divided by current liabilities purpose indicates short-term financial health. Interpretation. A ratio between 1.5-2 is often considered as a comfort zone 2. Acid test ratio formula. Current assets, inventory, divided by current liabilities purpose assesses immediate liquidity without relying on inventory. Interpretation. A ratio above 1 is considered the comfort zone, lower than 1 might suggest that they are cash flow problem. Efficiency ratios. These ratios measure how effectively resources are used. 1. Non-current asset turnover formula. Revenue divided by non-current assets purpose assesses how efficiently non-current assets generate revenue. Interpretation. A higher ratio is better. 2. Inventory turnover, days, formula. Inventory divided by cost of sales times 365 purpose indicates how long inventory is held. Interpretation. A lower ratio is better for efficiency. 3. Rate of inventory turnover, times, formula. Cost of sales divided by average inventory purpose shows how many times inventory is sold and replaced. Interpretation. A higher ratio is better. 4. Trade receivables turnover, days, formula. Trade receivables divided by credit sales, times 365 purpose measures how long customers take to pay. Interpretation. A lower ratio is better. 5. Trade payables turnover, days, formula. Trade payables divided by credit purchases, times 365 purpose, indicates how long the business takes to pay suppliers. Interpretation. A higher ratio can be better for cash flow but may strain supplier relationships. Working capital cycle. The working capital cycle measures the time it takes to convert resources into cash. Working capital cycle days equals inventory turnover plus trade receivable turnover, trade payable turnover formulas, inventory turnover days, inventory divided by cost of sales, times 365 trade receivables turnover, trade receivables divided by credit sales, times 365 trade payables turnover, trade payables divided by credit purchases, times 365. Why do we need to improve the working life cycle? The working life cycle plays a crucial role in a company's financial health. A well-managed cycle ensures better cash flow management, ensuring funds are available for operations. Reduced financial risk, preventing unnecessary debts and liquidity issues. Efficient inventory turnover, avoiding overstocking and dead inventory. Timely payments and collections, strengthening business relationships with suppliers and customers. How to improve the working life cycle, inventory. Improving inventory management. 1. Only order items that move quickly. Avoid stocking slow-moving products. 2. Optimize order sizes. Evaluate whether bulk discounts are worth tying up money in inventory. 3. Discontinue non-selling items. Do not reorder products that are not in demand. 4. Sell discontinued or near-expiry items, even at a discount. Helps recover cash. 5. Offer significant discounts to cash buyers. Encourages immediate sales. 6. Consider a just-in-time (JIT) approach. Orders are placed only when needed, reducing holding costs. How to improve the working life cycle. Improving trade receivables. 1. Be selective about which customers receive credit. Not all customers should have access to credit. 2. Set appropriate credit limits. They should be large enough to be useful but not excessive. 3. Avoid being too generous with credit periods. The longer the period, the greater the risk. 4. Offer cash discounts for prompt payments. This encourages early settlements. 5. Implement a structured chase-up procedure for late payments. Define clear actions for overdue accounts. 6. Be strict with policies. If customers know they can delay payments without consequences, they will. How to improve the working life cycle. Trade payables. Improving trade payables. 1. Do not pay before the deadline. Keeping money longer improves cash flow. 2. Balance cash discounts and liquidity. Paying early for discounts should not harm cash flow. 3. Maintain communication with suppliers. If payments may be late, inform them. Silence may cause tension, while discussions can prevent legal action. Solvency ratios. These ratios evaluate a company's long-term financial stability. 1. Net working asset to revenue formula. Net working assets divided by revenue times 100. Purpose measures how effectively working capital is used. 2. Interest cover formula. Operating profit divided by interest payable. Purpose assesses the ability to cover interest payments. 3. Gearing ratio formula. Long-term debt divided by capital employed times 100. Purpose measures the proportion of debt in financing. Investment ratios. These ratios assist in evaluating returns for investors. 1. Earnings per share (EPS) formula. Net profit divided by number of shares. Purpose measures profitability per share. 2. Price earnings (PE) ratio formula. Share price divided by earnings per share. Purpose assesses investor confidence in growth potential. 3. Dividend per share (DPS) formula. Total dividends divided by number of shares. Purpose shows the dividend earned per share. 4. Dividend yield formula. Dividend per share divided by share price times 100. Purpose assesses the return on investment through dividends. 5. Dividend cover formula. Net profit divided by dividends. Purpose shows how many times dividends can be covered by profits. Benefits and limitations of ratio analysis. Benefits. 1. Enabling managers to build up a trend of performance over a number of years. 2. Helps identify where improvements need to be made for the future. Benefits and limitations of ratio analysis. Limitations. 2. Ratios must be reasonably accurate. 2. Information must be timely to be useful. 3. Ratios do not explain the cause of changes. 4. Ratios do not consider seasonal factors. 5. Items like inventory, trade receivables, and trade payables fluctuate, distorting ratios. 6. Companies may have different policies for depreciation, profit recognition, reserves, and dividends. How to solve ratio PYP questions, step by step.
For question AI, current ratio to 2 decimal place. The formula is current asset divided by current liability. The current asset is 42,000 plus 39,000 plus 2,000 plus 1,000. Current liability 29,000 plus 8,000 plus 1,000. By using the formula, we will get 1.79 is to 1. For A2, liquid asset ratio to 2 decimal place. Its formula, current asset minus inventory over current liability. Current asset 39,000 plus 2,000 plus 1,000. Current liability 29,000 plus 8,000 plus 1,000. By using the formula, we will get 0.89 is to 1. Trade receivable turnover days. Trade receivable turnover days formula is trade receivable divided by credit sales times 365. 39,000 divided by 156,000 times 365 is equal to 92 days. Trade payable turnover days formula is trade payable divided by credit purchases times 365. 29,000 divided by 88,000 times 365 is equal to 121 days. Inventory turnover days. Average inventory divided by cost of sales times 365. 38,000 divided by 80,000 times 365 is equal to 174 days. D. Discuss the ratios calculated in Part A in respect of TOL limited liquidity and comment on the overall position. So, from the previous answer we got, we'll use it. So, TOL limited liquidity position is not very strong. The current ratio of 1.79 is to 1 suggests it has enough current asset to cover short-term debts, but the asset task ratio of 0.89 is to 1 show a risk if inventory cannot be sold quickly. It takes 92 days to collect receivables, which is slow, while suppliers are paid in 1 to 1 days, meaning the company delays payments to manage cash. Inventory is held for 174 days, which ties up funds. Overall, TOL Limited may struggle with short-term cash needs and should improve cash flow by collecting receivables faster and reducing inventory level. Question number C. Explain 3 limitation of ratio analysis. Number 1. Results are based on historic costs. May be misleading if results are compared over a long period. Number 2. Ratios only show business performance results. They don't explain why the results are good or bad. Third, different industries will have different ideal ratios.